If you're new to managing your own investments, it can seem overwhelming at first. There's a lot of industry jargon that can make it seem impossible to figure out. But I'm here to tell you that there are a couple of key concepts that, if you understand, will go a long way towards helping you become a more confident investor. So today I want to talk about the concept of diversification. Diversification is essentially not putting all of your eggs in one basket. I'll explain what diversification is and how you go about implementing it. So essentially, as I said, diversification is just not putting too much of your money in any one company. Think back to things like the failure of Enron or Lehman Brothers. For investors who were heavily invested in those companies, they lost their full investment. Diversification means spreading your funds across a variety of companies to help protect you in an event like those that impacted Enron or Lehman Brothers. So diversification is important because it helps you reduce your overall risk. By spreading your investment across a number of companies, the impact of any one company performing poorly will not have an oversized impact on you. For example, you could imagine a scenario where technology companies are hurt by a new piece of legislation, but healthcare companies or automotive companies are still doing well. Again, if you're spread across these companies, you won't be overly impacted by the change that's affecting only the technology companies. There are several ways to think about diversification in your portfolio. The first way is diversifying across asset classes. So that means investing in stocks, bonds, real estate, making sure that you don't have all of the investments on only one type of asset class. The second way to think about diversification is geographic diversification. You want to have both US and international companies in your portfolio. And the third place that you want to diversify is across sectors. So again, technology, healthcare, consumer staples, things like that. You don't want to put all of your investments in just one sector of the economy because sometimes certain sectors don't do well and others are doing just fine. If this diversification principle seems overwhelming, don't worry, there are things out there to help you. So mutual funds and ETFs are specifically there to help investors create a diversified portfolio without having to manage hundreds or thousands of individual investments. You can buy a single mutual fund and be invested broadly across the US stock market, for example. So by using these tools, you'll be able to create a very simple portfolio for you to manage, but that is well diversified across the market. Similar to asset allocation, diversification requires ongoing monitoring and maintenance. Different sectors of the market will grow at different rates, and over time you'll skew away from your original diversified portfolio. So you want to make sure that you're going in at least twice a year, rebalancing your portfolio and making sure that it remains diversified over time. So to wrap up, diversification is a key concept for those starting to manage their investments to understand. It essentially means spreading your investments across asset classes, geographies, and segments of the market. By understanding asset allocation and diversification, it will go a long way towards making you a better investor.